Hi everyone, my name is Andrew Codd and welcome to this webinar on how we can help finance professionals and finance teams unlock more value within their organizations by bringing them a bit more out from their caves. And I'd like to start with a story because a few months ago, around the time when the US was under threat of having their administration services locked down and Brexit negotiations were being kicked around the Houses of Parliament by MPs in the UK, and one of my favourites, the Lego Part 2 movie, was just out in cinemas. We decided as a family to move house. And I suppose within the first week, or towards the end of the first week of being in the house, we were rushing to get the kids out the door, out to school, and I had a busy day at work to go ahead into. And as we were leaving the house, I looked up at the ceiling and saw a brown stain developing. Then I was trying to think in my head, did I see that before, whatever, and I think it was actually, I probably hadn't, and it looked sort of quite big and angry, so I said, look, I had quite a busy day at work, so kids need to get to school, I would deal with it later. And I go on my merry way to work, only to get a phone call from my wife a bit later on that day, just as I'm about to finish up, saying, can I come home quick? There was a bit of a problem at home. I said, oh, that's interesting. I didn't even actually think about what I'd seen earlier. It was only when I walked in the door and looked up and saw that water was now escaping from the ceiling. And I thought, my goodness, what a bit of a headache to go have. I mean, the last thing we needed after moving into a new house was having a problem with a leak in the ceiling. I mean, I didn't even know where the main stop valve was for the water in the house because we were just there. It was new to us, and I suppose even if I knew how to stop the leak, how would I go fix the leak then? I don't even think I had the tools in my workshop to go and figure out if I could fix it, or what contractor to bring in, or is it just a plumber, or is it a builder, where to start? So it wasn't a pleasant challenge to have. And I think there's a lot of headaches out there within finance at the moment on how to unlock value. Actually, not just necessarily how to stop the leaks happening in terms of work maybe going to other teams or being done in different ways, or people leaving finance teams because they're becoming a bit disillusioned or disengaged with the work. And then also moving beyond that, how do we provide an environment that is actually allowing for more influential finance professionals who can go and solve meaningful problems for their organizations, unlock value, and have successful and rewarding careers in finance. And at least we're not having those headaches around prehistoric caveman times, because if we were, the common tool and method for solving for those headaches would have been something known as trepanning, which would involve a fellow prehistoric human being, caveman or cavewoman, reaching for a small rock or something with a sharp edge and proceeding to tap or screw away at our heads to make a small surgical hole around the area of the headache to release it. But the interesting thing here is that potentially, although well-meaning activity, could involve some unintended consequences or side effects, like even more bleeding or more dizziness, or in some instances death. I mean, but I suppose that the headache was solved, right? But I think we're having a similar challenge in finance today amongst finance professionals, finance teams, and finance leaders, is that there's a lot of well-meaning activities going on. Tools are being employed, some old, some sort of new ideas, particularly around robotic process automation and artificial intelligence. However, these are causing some unintended side effects and consequences, particularly around levels of disengagement, but also us falling short of our sort of well-meaning aims. I mean, 99% of leaders within organizations want to become more insights-driven, but only 1/3 feel that they are. So there's tremendous opportunities, and as finance professionals, I believe that we have assets around us to go and actually deliver and unlock value. So that's why, in the case study I'm going to show later, some results. And amongst those results of that case study was actually a 50+% reduction in the staffing costs of a finance team, because the tools I'm going to share with you actually can be done on a global scale, so they don't necessarily have to be done in one location, so it allows the work to be optimized around the world that we do in finance. Also how finance professionals can drive from the case study additional margin, and in this case it was $60 million of additional margin that the finance team are directly responsible for solving and implementing, and also how we can work with the business and deliver value in an indirect way. So a lot of you listening in or watching in will probably think, oh, that must be because of your resources are very good to be able to achieve those results. They must be exceptionally good at unlocking value. And I would probably challenge that, because I don't necessarily believe there are any resources without resourcefulness. You know, for instance, if you think about oil, oil as a resource is only defined by our ability to go use it. We figured out many applications for oil, but for the cavemen and cavewomen of many thousands of years ago, oil was probably more than nothing than a black sludge. Thing is, if we understand how to go do something, then we're all standing on an oil well of opportunities, just waiting for us to become more resourceful enough to go execute on them. And if you don't believe me, try to imagine what would happen tomorrow morning if Sir Richard Branson, the entrepreneur and founder of the Virgin brand, swapped lives with you for a year. He'd get your job, your challenges, your car, your friends, family, your bank account. He'd even take on your name and appearance. And in 12 months, when you swap back, do you think there might be some noticeable changes in some of the outcomes you've had in dealing with your stakeholders, unlocking values for your organization? Do you think he might have spotted opportunities you might have overlooked, or picked up the phone and had conversations that you might not have had? You know, and then what about poor Richard Branson? You know, when he's got to go back to his life a year later. Do you think if you hadn't been as resourceful as him, that his island might have become repossessed, that his management team might have resigned, or that even his spaceships just went missing? So I guess we probably all want to have the resources that great finance teams have, or that Sir Richard has. But if we all got a little bit more resourceful than we currently are, then we might find ourselves unlocking value. And the first step, I guess, really to unlocking value is to make that commitment. If we make the commitment to be more resourceful and to go unlock value, then we actually end up becoming more resourceful. And this is going to be a challenge for us, because as finance professionals, if we look at our history, I'm not saying all the way back to caveman times and coming out of our caves from back then, but maybe back to Babylonian times, around 2000 BC, we've not really been that resourceful. Yes, we've been able to record transactions and help safeguard the value of assets for organizations and the clients we've worked with, but it wasn't really up until the Industrial Revolutions, about 3,800 years later, where we actually started to develop ways of accounting and how to perform financial analyses. We even came up with great mindsets around finance business partnering and financial planning and analysis, FP&A, but not a lot of finance teams or finance professionals have adopted these. So resourcefulness isn't really necessarily within our DNA, so it's something we probably have to work on. And to even make it a bit more difficult, it can sometimes be difficult or tricky to define what value is in the first place. And that's why I often use the example of water, because water can take on different value depending on the context we find ourselves in. I mean, we might assign very low value to water in the context where we're just, mildly thirsty and want to go grab some tap water or go water our lawns to keep them nice and green in hot weather. And we might assign even a higher value still if we decide to buy a premium water brand like a Perrier or something like that with our meal if we go to a restaurant. And we might even find ourselves assigning a higher value still if we were caught out in the desert and sort of forgot to bring some water with us, and we've been exposed to extreme heats, 40 plus degrees Celsius or 100 degrees Fahrenheit or more. So we would assign even a higher value still there, right? And similarly in organizations, the decision makers we work with, they might have different value challenges or opportunities to unlock value for, depending on the context we find ourselves in. And that's the interesting thing for us as finance professionals. We've got a great visibility across organization. We've access to decision makers, access to data. So we should be able to, if we're trained in the right way on how to look for this and given the right tools, figure out the various value contexts and help unlock value for organizations. And to borrow from Peter Drucker's old saying that the purpose of a business is to go and create and retain customers. And if we look at that, the numbers or the results of an organization are based on the decisions that are made, then unlocking value creation becomes simply about helping our organization's decision makers make better decisions over time that create and retain customers in a sustainable, profitable way. However, the approach we've been taking to do this so far in finance has actually been to tell people that we need to do this. Yeah, it's been saying things like, you need to become more commercial. You need to come out from behind your desks. You need to be more like a consultant, less box ticker, more strategic. You need to be more influential. You need to go get a seat at the table. We're being told what to do. And it's just assuming that when we tell people to go change and do things differently, that they will. But we know that that doesn't work very effectively. And how do we know that changing behavior is difficult? Well, we could look at a study done on heart surgery patients, because these heart surgery patients had the ultimate incentive to change their behavior, to adopt a more positive lifestyle. You know, they were given a second chance. And how many people do you think those researchers found that people adopted this more positive, changed their lifestyle in a more positive way? Do you think maybe 90%, 80%, 50%? Well, the researchers actually found that only 1 in 9 people, 11% of those underwent the heart surgery, were able to change their lifestyle. And they had the ultimate motivation. You know, they'd have death if they didn't. So, you know, if changing one's own behavior is difficult, then imagine how hard as a finance professional it's going to be change our behavior, or change the behavior of others if we're a leader trying to get them to change, let alone changing the behavior of whole finance teams and organizations. Yeah, it's bound to be 1 in 9 or even less. So why are so many finance professionals or finance leaders telling people to change behavior when the results speak for themselves? It's not going to be very successful. And I suppose I wouldn't really know the full reason why that is, but I would point out is that when we're doing things like that, we're overlooking a fundamental truth or the answer that's already right in front of us. We know the importance of the fundamental truth that income follows on from assets, yet we've chosen to ignore it and focus on behavior instead. And that's an interesting one, because if we go back to the story I started with, recently we bought a house, we acquired an asset. Not even a week after acquiring that asset, there's a leak in the ceiling. There's a hole developing in the ceiling. What do you think's happening to the value of that asset? It's declining, right? There's a deficiency. So something needs to be done. Something needs to be fixed. And the thing is, with that asset deficiency, I didn't feel it was acceptable for where I spend most of my week in my home, or where my family spends most of their week. I didn't feel it was acceptable to have that asset deficiency there. And it's an interesting challenge I'd like to make to those listening and watching this webinar is, would you agree it's also acceptable that, given that we probably spend the second most amount of time during our weeks at work, that we continue to have asset deficiencies there, and that it's acceptable? That, for instance, we sort of, paper over them or do the wrong things and not fix them properly. And therefore, we tolerate it. And maybe that's part of the challenge we're seeing with the levels of disengagement out there, or people not feeling that they've become influential, is maybe that we've just been tolerating these deficiencies. However, the fact is, once we decide that we don't want to tolerate these deficiencies anymore, Once we decide to look at our challenges in finance, not as one of an expense or a behavioural problem, but one of solving for asset efficiencies, there are actually two courses of action available to us. And it's just like repairing a hole or a leaky ceiling. The first one is, I think, what a lot of larger companies tend to do, is they tend to get on the phone to a contractor and get someone in and deal with the problem and throw a lot of money behind it. Now, that actually sort of does make a bit of sense, because if you bring in the right professionals and they do the job as expected, then you should accelerate the time to outcome. And indeed, that's what I do around the unlocking value. If you pay for it, you should get an accelerated time to delivery. But the other approach, and this is the one I'm going to spend the rest of the webinar on, is the DIFY, do it for yourself approach. Because a lot of these tools are accessible. This is what I want to share with you, is help you understand what those tools are so you can leverage them. And the thing is, we have a lot of these tools, and I like to say assets, already at our disposal if we choose to identify them. But it's very easy when you're caught in the day-to-day to miss or overlook a lot of these assets, and they turn up in the shape of the systems that we use to go and do our works. For instance, our standard operating procedures to go through a month end, the reports we send out to stakeholders, the advice we might give someone on their tax affairs, also how we choose to engage with our stakeholders, the meetings we hold, the implications we point out based on the various trends that we're seeing, and in some instances how we go and deploy and help businesses unlock value. We're already doing a lot of the great things already, but we may not necessarily notice some of those assets. And to borrow from an old saying, how can you recognize a masterpiece when your nose is pressed up against it? So let's stand back for a second, and what I've done here is I've tried to replicate that old saying by taking a small bit of a picture as if our nose is pressed up against it of a very famous painting. And I've kept it up there for a minute or so to see if any of you have recognized it. And we did have one member, I gave a presentation once, she was a finance director and actually was able to identify the painter, the artist, not necessarily the picture. But it's a very well-known painting. So it's actually A Sunday on Le Grand Chat by Seurat from 1884. And given this as a webinar on value and unlocking value, this was sold a number of years ago for about $40 million. So first step is to even step back actually to identify our assets. And you can even decide to give them various names. I've identified 6 for you, and I've used these names. And if you look closely, they even spell the word assets. So you can come up with your own definitions of your assets, or you can leverage these ones. It's been done here for you. And I'm not going to go in and out of the details of all of these assets, but I just wanted to show you that those assets lead to a number of value drivers or value behaviors that they're underpinned by. And then also these assets help deliver on the 3 value disciplines that internal or external customers are looking for from finance teams, helping them unlock value or value creation and capture within their organizations. And then the linchpin of the whole system is actually your value potential pulse score, is knowing how your assets are scored or what their value is, and where you do well and where you can do better. So you can actually go and do something about enhancing them and addressing any deficiencies that you might find in your assets. And it's really about knowing that pulse, that sort of linchpin of the whole system that allows you then to go and unlock value creation. So the way we used to do this in the early days was actually send out a survey on SurveyMonkey and collate the results in a spreadsheet and do it that way. Nowadays, we developed a web app, so it's a case of going in and doing 36-question positive negative scoring. Takes about 5 minutes to complete, and then at the end of it you get a report in terms of what your value potential pulse is, but also what you do well and where you can do better, with some prescriptive guidance on what you can start doing straight away and some of the tools you can borrow from. And here's the pulse score and how it shaped out for the case that I mentioned earlier. It was a commercial finance team of 11 based in two main countries, United States and UK and Ireland within Europe. And when we ran the numbers on them and they completed the survey, it turned out that they had very good, strong financial analysis and acumen assets in the team. That wasn't the main challenge. They did that very well. In fact, it was a strength that had been very much well developed. Where they struggled was in their discipline around influencing, the social intelligence and engagement assets, which is not uncommon. This tool's been around a while, and we've been able to consolidate many hundreds of results around the globe, across many industries, many various levels and organizations. And this does seem to be a common area within finance teams and finance professionals to address asset efficiencies. So how this was manifesting in this organization was this finance team used to do the reporting of the results, and that was taken off them and given to operations to do. They used to do the assurance work around making sure prices were correct. That was taken off them and given to the quoting team to go check that was being done right. And in terms of having a seat at the table, there was no finance person sitting at the table. They were deemed irrelevant and didn't have any influential. I guess that's why we had to go do this work and fix it. And that reminded me, I guess, the premise of this sort of linchpin asset-based approach is what gets measured gets managed. If we start making a commitment to unlock value, if we start measuring how well we're doing at that and set ourselves targeted areas of development, then in theory, we're really giving ourselves the best chances of success. And if you think about, again, back to the operating table and the heart surgery results of that study, telling people to change behavior without knowing where to specifically focus and measure your improvement from A to B, or in this case from a lowering score, value potential pulse on how to get to a higher one, is probably a better way of success than just continually telling people that they need to change. So given this is a do-it-for-yourself approach, I'm going to share with you 3 approaches we took in the case study to share with you in terms of how you can leverage what's already there in terms of useful tools that you can take back to your teams or put into your work to help them unlock value. The first one is mentoring and coaching, because even though a team might score poorly on a particular asset area, now in this is actually from a different organization, but because the differences were so stark, I wanted to show you this one, was it may score poorly overall, but there actually might be someone in the team that is actually very strong in that particular area. So if you were able to identify that person with the strength, then by having them mentor and work with others who are perhaps not as strong, helps bring up the overall asset value within the team. And that's what we found in this scenario. In fact, the person who was doing the mentoring up until that point had only ever regarded themselves as an individual contributor, someone who was very technically strong, and that's what they valued their contribution on. During this process, they actually ended up asking if they could perhaps do some management training and perhaps even become a team leader, because they hadn't really explored that until they got involved by helping others, and they found that process very rewarding in terms of developing others. So that was quite an interesting outcome as well from this mentoring approach. So you actually develop leaders within teams. And again, I think that helps ensure that the assets become much stronger together. The next approach to go target some action around is another free resource, generally speaking, is to go access some finance podcasts. Now, I'm unashamedly unashamedly recommending the Strength in the Numbers show because I founded it to be a financial mentor podcast where people come on, share their experience of what worked well and what hasn't. They deconstruct it into steps that anyone else can follow to look over the fence and see what it likes first before taking the step of coming out from our caves. Just reduces a bit of risk and shows the way that we can all follow. But it was also set up in a way where you can, after a podcast episode goes out, there's detailed timestamp show notes. So if you went into the website and put in the key term you're looking to develop on or get some mentorship on, and you put that key term in, it'll point you to all the podcasts where that term comes up, and you don't even have to listen to the whole podcast, just the relevant sections. So again, maximizes your investment of time, because for some of us who still struggle with thinking of finance as an expense, and we are very busy, there's a lot of demands placed on finance professionals and finance teams. So the bigger bang we can buck in terms of our time, then that's going to be very useful. But, I'm just going on about the Strength in the Numbers podcast. There's loads more popping up that are very valuable to work in. But I do want to call out one particular episode. That was an interview with Stan Vesco. And Stan actually shared with us a solution on how to get more finance professionals spending more time doing development and developing on the right things. So there was what he used to do with his team is they used to agree together what were really good sources of advice to enhance their development, what team members had been finding useful. And out of that, they worked up a syllabus together. And then Stan would go block time in their diaries, like himself personally, block time in their diaries, so that they should go away and invest that time in doing the development training. So that could have been following up on an article or white paper, listening into a podcast or watching a YouTube video or TEDx talk or something along those lines. And then to ensure he did it, he would actually have a call straight after with them to go through what the learnings were and to help him understand what they found useful or could have been better. So these are the types of great bits of advice that guest mentors sort of share on show and also across other finance podcasts too. And to the final area of targeted action, and this could be a bit of a contentious one, is targeted workshops. Because a lot of finance professionals, we do place a lot of value on continual professional development. So we're very familiar with attending workshops or online trainings and so on and so on. However, how many of them are actually targeted at unlocking and creating value, as opposed to preserving value in terms of technical standards versus practical value creation tools? For instance, going back to the case study in terms of establishing better influence, one of the main challenges that team was having and why they were scoring so poorly on their social intelligence asset was that they had no real understanding on what the haves and wants were of their main customers within the organization. They hadn't invested the time to go and ask them. Because if you think about it, like this tool here, this is the stakeholder analysis tool. The value in having this practical tool that anyone watching or listening to this webinar can leverage from is that if you go and identify your stakeholders and ask them have-want questions, you record the difference between those two, and when there are differences, that's a gap to go solve, that's a problem to go solve. You solve that problem, then you're adding and creating value for your stakeholders there. It helps develop credibility, a track record, and allows you to build better influence. So like us in the team with the really great insights, the stakeholders become much more receptive and you have much more influence to go and solve meaningful problems for them. So it's a great, very simple tool. And again, with the case study, the workshops I'm talking about have to be practical in nature. They involve a lot of simulation. Yes, a little bit of theory, but I think that's the challenge with a lot of finance courses. There's a lot of theory where there probably should be a bit more balance or weighting towards simulation, case studies, and leveraging tools so that they can be applied to the job. And when you start closing those gaps, you should also start tracking the value that's being contributed, particularly if you're doing it for yourself. So, for instance, the numbers I put up earlier, you can have direct or indirect contributions to value. Some of them might be a bit more difficult to value, but let not that stop you from trying to record value in some way. So the value might come through in the form of testimonials. So the number of positive emails or good feelings that the finance team has helped generate when working with stakeholders on various things. And what gets measured gets managed. As you start rolling value logs out to team members, and you've got all team members, like we had in the case study, focusing on value creation, then the overall team and the overall organization is tuned into it. Like for instance, there was one example, even in accounts payable, where an AP clerk or associate had actually identified nearly £1 million worth of opportunity because they noticed that the credit notes hadn't been coming in for the pallets that were being invoiced with the bottles that they were on. So, it doesn't have to be a commercial finance team. It can be any team. Even accounts have opportunities to go and create value for their organizations directly as well as indirectly. So what you should find by after doing all these tools and targeted actions and putting them into place, that your assets should be getting less deficient and becoming stronger. And this is actually the results only 5 months later of that case study. So you see a lot of the red disappearing, there's a small bit of pink and a bit of orange left, but essentially it was quite transformational for this team. And just to go or signal how well this team had done, the sales organization that this team were supporting, the CFO still felt that finance was a bit of an expense and viewed it that way. The sales team actually offered to pay for 2 finance resources to come in because they could see the value of investing in finance as opposed to a quota-carrying rep for their organization. So that was just an example of a turnaround. In fact, I've just gone through a value log on what gets measured gets managed. That's one of the greatest testimonials you can get, is having another organization willing to invest in the finance team. Not to report into sales, still to report into finance, but funded by sales because they felt that would drive more value for them than investing in additional reps. Now there's also some other approaches or ideas for you if you're doing the DIY approach, do it for yourself approach. And one is, some of the older listeners and watchers might be familiar with mixtapes that we used to have back in the day, or in modern days I think they're called playlists. But it's essentially ways of accelerating the focus on particular areas. Now luckily I've got access to a backlog of various podcasts with the Strength in the Numbers show. But you could also decide to look at individual shows and other shows and combine them together with just snippets of various bits of advice that help accelerate the building and creation of that asset. So I encourage you to maybe develop your own ones, and that could be a great investment of time. I've also had some large organizations come to me, multinationals come to me and talk about setting up their own internal podcasts, and I think that's a great idea. It's all going to help with building those assets, because with podcasts, for instance, or videos, they're sort of there forever and easily accessible by everyone after that initial investment of time. All I would sort of caution there is just remember we are trying to come out from our caves here. So in terms of when we're doing that, perhaps think about involving some external sources as well. So you're growing outside of your org and as well as inside. Also, for a small investment, because I know this because I've been talking to a supplier from China, but you can develop some sort of ready reckoner cards or easy to access cards if people just want a quick idea on how they can enhance an asset. One of my favorite ones is actually how to conduct effective meetings. So the user of this would actually use both sides of this card, and they'd have it with them to reference at all times to identify the questions that they need to go through if they're chairing a meeting to get the most value out of it for those that are attending. And actually, as much as there's a physical route to doing this as well, we're also developing an app to put these on so people can access them via their smartphones. And I suppose a lot of practical tools have been fired at you, but I suppose it's also a bit like learning a new language. Let's say you want to learn how to speak French, for instance, right? The fastest way probably to do that is to have all your attention forced there. So by moving to the country for a period of time, becoming absorbed in the culture and the language of France. And similarly, when it comes to unlocking value within organizations, what I've been sharing with you is some of the language around it, some ideas, some tools that if you become exposed to it and keep measuring it over time, you should be increasing that value potential pulse and reducing deficiencies in your assets and making what you're doing more valuable to your organization. And that for me is a bit like an orchestra when it's setting up. As in all our experiences of doing this a number of times now, it's a bit noisy and a bit disjointed, for instance, as musicians and orchestras, like they tune their instruments. But as they get in more tune and they start working more as a unit, they're getting more in sync. And synchrony is a technical word, yeah? It means like when the different parts of finance are unlocking value together and they're firing in similar ways at similar times, they're firing in sync. And you invoke something called Hebb's Law, which says that cells that fire together wire together. So when you put all these tools and ideas and language together, you know, and you're paying close attention to unlocking value, it's actually making the assets of the team and also of the individuals in that team much stronger. So much more sustainable, much more resilient, and much more meaningful to those working in them, but also for those that they're supporting within the organization. Now, I've been making this sound all nice and easy from a do-it-for-yourself approach, and I'm sort of smiling a bit because I'm just remembering some of the challenges that have happened. It is generally a worthwhile process, but you will come into a couple of challenges, and these are the two main ones I've seen. And experience is typically the most non-finance teams or people who aren't finance professionals have low expectations of accountants and finance professionals historically. I mean, it's interesting because, you know, finance professionals were pretty darn good at preserving and safeguarding company assets and ensuring there's compliance and controllership. It's just, I guess that, you know, our organizations probably are sometimes guilty of maybe not expecting any more, just not thinking that we can help them unlock value. Or maybe it's just they find it difficult dealing with us because we seem to speak our own language. You know, we seem to talk in terms of revenue recognition standards or lease accounting or NPVs or GAAP or GMs, EBITDAs, ROIs. Or we might hide behind complicated spreadsheets that only we can decipher and it's difficult for others to follow. And if you've ever been to a dinner party and been asked, like, what you do for a living, and you say you're an accountant, the conversation just stops dead there. It feels like people don't think there's much extra value to be had from an accountant. And, you know, there was a study done by the Australian Finance Review, and it was well summarized by David Boyer in a TEDx talk on it. But essentially, imagine you're at a barbecue, and there's 10 people there. Now, 4 out of 10 of them won't even talk to you about their financial affairs. But some will, the rest will. So most people do want to talk about their financial affairs. 2.5 of them, though, will talk to their business partners or work colleagues. 1.5 of them will talk to a family member or friend. And only 1 will talk to an accountant or finance professional. And interestingly, when you look at the outcomes of those conversations, it was found that those speaking to their business partners and work colleagues, there was only a 50% chance of a successful outcome. So a 50-50, a coin flip, right? When it came to the family member or friend, it dropped to 25%. But for an accountant and finance professional, it was an 83% chance of giving positive advice, a massive increase, right? But the fact is, people don't want to speak to us. Yeah. And a way most of us can solve for this is just to come out from our caves, go and engage with people and try and understand their challenges. And once you've identified their haves and wants, is close those gaps or work with others to go close their gaps or work with them to close their gaps. to give them those positive outcomes. And then the other area, I think it's probably more of an impact, but if we think about it, why do most people pursue a finance or accounting qualification in the first place? I mean, if it's anything like me, I just wanted to know the skills or learn the skills on how to run a financially sound business. Yeah. But how many of those certified finance professionals go off and start a business? Yeah, not many. Most actually become auditors, controllers, analysts, finance directors, VPs, and so on for existing companies. And this is because their training or their qualification routes focuses on how to safeguard and preserve existing assets, not how to fix for asset deficiencies or create new ones in the first place that unlock value. They've just not been taught how to create value from scratch, to start with little or nothing or in terms of the way of assets and go and create and unlock value within finance for organizations. And like the assets based on this linchpin approach that I've shared with you, it gives that common vocabulary that will help deepen finance professionals' mastery of taking an asset-based approach, ingrain into our thinking, into our DNA, so that we can go and create more influential finance professionals into the future, solving meaningful problems for organizations. And I just feel that our leaders are drowning a bit, because without that type of training or type of understanding or common vocabulary, it's like they've been pushed into the deep end. And of course, we all know there's two ways to learn to swim. One is just that, push someone into the deep end and hope they can either sink or swim. And the other one is to actually go to a more structured approach, have a targeted approach where, depending on someone's existing strengths or level of value or ability, is to go and sort of either give them one-to-one tuition or show them YouTube videos or give them detailed instruction, whatever way suits their learning best. But it's a bit more structured and it's going to be a bit more successful in terms of helping them not just avoid drowning, but be successful swimmers. So once it's instilled once, it's just a case of keeping it up to date. I mean, essentially, a business succeeds because it was designed to succeed. It's fundamentally an ecosystem of assets that have been developed and utilized efficiently. It's a blend of our knowledge, it's our capital, it's equipment, it's the staff, it's the systems, the leadership, the innovation. Each component there is thought through, improved, refined, enhanced, any deficiencies addressed. Yeah, and the same can be said for finance teams and finance practitioners. Once we all know our assets, whatever we define them as, we'll be better able to plan where we need to concentrate our resources, our time, our efforts, diagnose specific bottlenecks, fix them, and over time improve them much more rapidly. It will, coming back to the start of the presentation, reduce our headaches and frustrations that we're having to more quickly unlock value for our organization, stakeholders, and customers. Throughout this journey, when it comes to unlocking value, a lot of folks have said to me they wish they'd known this sooner. It would have saved them many years of trial and error, and that's a main reason why I started the Strength in the Numbers podcast, to reduce this time and speed up the value. And that's why this linchpin approach, revolving around these 6 assets, it took me years to discover, sat with hundreds of business finance leaders, executives, senior staff, individual contributors, engaged with them emotionally, their struggles, frustrations, and this blueprint has just emerged from those hundreds of meetings and solving problems and helping them overcome their obstacles. And that's, for me, I think, where we need to go as finance professionals. We need to view ourselves no longer as accountants or finance professionals. If we wish to address the sort of image problems and leadership problems we've been having, that might be the biggest challenge, I think, in terms of unlocking this value, is probably to become more like financial mentors. And by that, I mean, it's actually walking with those we're trying to unlock value for. Yeah, so whether it be a manager or a fellow colleague, it's to help find their vulnerabilities their biggest areas of concern. Manage those, preserve them, protect them, safeguard them. We've got great skills in that place over many thousands of years. And the next one then is to go help them find opportunities to go unlock more value, capture them, not walk away after we sent out a report or analysis or did a return. Is to actually play a bigger game, for value creation. Help them drive stronger numbers, add more value than we currently are. And we could do that if we just addressed any deficiencies we had in our own assets and enhance those. And look, ultimately, I'm thinking of the generation coming up along, who want to have meaningful careers. Finance is just an amazing opportunity, a place to work. It should be great fun. So just let's make sure that we're giving everyone around us the skills and assets to do the best that they can do to unlock value in our organizations, make a tangible impact, and get the most out of their careers. So look, I hope you found this useful. I throw up some resources that could be a benefit if you want to connect or follow up further. You can read my category best-selling book. You can connect with us on LinkedIn or send me a direct email at andrew@sitnshow.com. And you can also subscribe to the podcast where we bring on a different guest mentor every week, and also have a Monday memo which actually goes through some of the tools that unlock value, as I said, every Monday as well. So we've 14 or so minutes left, so happy to take any questions. So, hi everyone, and my name's Andrew Codd, as you're probably aware, and happy to take any questions and give my best at answering them. I can see some coming through on the Q&A box, and if some of you need to drop off early, just want to remind you that for all those that have registered, this webinar, I'm told by the organisers, will be sent out. And if you want to sort of chat more in person, I will be over at the AICPA and CIMA transformation event in mid-September. I think it's the 19th and 20th of September over in London. So look forward to meeting and chatting with some of you there. But for now, I've got one question there from Leonard, and I'm asked about the blueprint. Is there a printed version of it available? Well, in terms of the high level, I'm happy to share that, Leonard, by email. If you want to email us at andrew@sitnshow.com. The details, though, that's a lot of the secret sauce on that. So I'm happy to talk to it, but I won't be sharing that. I think I've given enough of a do-it-for-yourself approach outline there that should help most people. Oh, great question from Andrew Ward. He made me laugh. Do you find the finance staff tend to be risk averse in preferring caves? That's an interesting one. I feel that we are a bit risk averse to some degree, and I don't know if that's actually because it's the easier approach, it's the more comfortable one to take. Because remember, if we're having to venture out from our caves, that's actually a little bit uncomfortable, and that's why I don't really understand sometimes with finance professionals, is because when you think about understanding is simply trying to deal with and cope with what's going on around us. So when we step out of our caves, that's all we're really trying to do. I wonder then, is the risk aversion coming from because we're just quite reactive? Is that where it's coming from? Is it that we're sort of waiting to have our partners in the business, our customers, come to us with asks and then provide them advice or reports or analysis around that? I'm not really sort of think we're fully maximizing our capability on that one. So I'd say, is the risk aversion coming from just being in that sort of overloaded mode, not having the time or space to think? And when I look around and actually talk with the guest mentors that we bring on the Strength in the Numbers show, and from my own experience, it feels that those who get the most meaning and the most, I suppose, happiness or rewards from careers in finance tend to be those that are actually finding space to think, and not just think about what to do and how to better serve the business and their organizations, but actually also to appreciate some of the good things they and their teams are doing. So, yeah, I suppose we could prefer better things than caves, definitely. Although I'll leave you on one thought. I did work in an organization, and no joke, the finance team actually used to be in part of the business in the building that was actually called the cave, and people called it the cave, and finance actually worked from the cave. So yeah, they wore that as a badge of honor, but then again, they were quite a reactive finance organization and very, very risk averse. You'd never see them going long on a forecast to overachieve a forecast. They would always try and I suppose over forecast and over deliver on their forecast and under forecast it. So yeah, Jan, I got a question from you. Would you recommend that coaches, mentors be finance professionals themselves in order to have sufficient credibility? That's a really good one. You know, I suppose part of my work is I've always had a fascination with smaller businesses and enterprises, and I get blown away just how smart and savvy some of them are in terms of making really good decisions. I'm sort of actually working on a project at the moment to bring some technology into the European Union for a business, and you know, they've never undertaken something to scale before, but they've actually got quite a good grasp of the numbers. Where I find them sort of letting themselves down is they tend to focus too much on growth, more so than on sustainability, and by that I mean sort of working capital. Have they got the firepower, the necessary capital to sustain a price war with the incumbent who's inevitably going to react to this technology coming in? And I think if you had that finance training, you'd probably have a better appreciation of it. Definitely, I think you're sort of more rounded. But I would actually say that I myself have used a coach and a counselor, and they've not been finance professionals. They have great life experiences. So I think we see a lot of finance professionals. We get a great broad perspective across the business, across our economies. Remember, you know, that is ultimately how economies or organizational performance is judged, is generally in terms of output that we sort of try and quantify or put some numbers or dollars, pounds, euro, cents around. And you know, that's why I guess finance is very useful to have from a life experience perspective. But I think there's many other diverse thoughts out there, and indeed, I suppose I've had some very positive experiences from people who are non-finance that have helped me become better finance professionals. Oh, good question, Martin. Do you see any major difference between the openness of finance professionals to identifying value in the USA and, say, Ireland, and Britain? That's a really good one too. Really appreciate the great questions for everyone listening in. I suppose one method or one key way of identifying that value is actually via, I suppose, business partnering, and that means a different thing. Actually, funny enough, in the US, that's what I'm picking up from my work there, versus the UK and Ireland, where actually the terminology business partnering was actually coined in the United Kingdom. And I would say that in the US, it's actually quite interesting. When you're working with like sales teams from a value creation perspective, they get it immediately. In fact, I've had the experience where American sort of sales leaders can see the value in finance teams so much they'd actually rather hire additional team members or headcount, let's use that word, in finance, as opposed to invest in quota-carrying reps. So they do get that there. Whereas interestingly, the same CFO of that organization was adverse to investing in his own finance team because he viewed finance as OPEX. Now I bring that over to the UK, and I think there's probably more of a a history in finance driving value without having to go to necessarily sales teams or commercial teams to gain that investment. But what I would say is probably in the last 3 years, I've seen a shift that has seen it equalizing that openness or those opportunities of finance to create value. And I would probably even suggest that there's a greater focus on it. I think it's captured well there was Anders Leo Lindberg. He had a great method actually, which was saying when you look at your salary, and challenge yourself. It's like, have you done your best to justify your salary to the business? Have you gone openly from out behind your desks and worked with the business or your organizations to try and drive more value than what your cost is to the organization? And Anders has also got great experience in the US too, as well as Europe. I would sort of say the two of us were seeing very similar in terms of, I think the playing field is leveling. And what's actually impressed me a lot about, maybe it's just because there's a lot more people in the US, a lot of finance professionals, a lot more, is there's a lot more noise coming out about how can we do it better. Whereas in the UK, we might just take it for granted. UK and Ireland, we just take it for granted that we're doing this already. Okay, I'm not seeing any more questions at the moment. I hope the ones I've answered so far are useful. There was one question I was sort of thinking before I logged on to this, and I was wondering if it could be controversial. If I'm just going with the flavour of the comments so far, it was actually should finance teams also have the responsibility of the human resource department? Particularly from that openness and business partnering perspective, that visibility, we're fairly independent. We understand the sensitivity around things like payroll or people's pay or promotions. And would actually that maybe even a good thing for us to bring more of a human side back into finance? I think a lot of us are going after the shiny objects around technology. And I just thought that was an interesting thought. So I'm going to probably put that one up in LinkedIn later today and see what people think, and I would appreciate your comments on that one. But I guess there was a lot of human-based questions rather than technology there. So actually, I hope some of the points we were making resonate, and I'd probably look to end and say a lot of our opportunity is already within what we know. It's about actually how to go and implement it and leverage the strengths that we already have. We've, as an organization, for instance, we may not exactly, like in some of the case study examples, we may not be great at influencing, or we may not be as agile as we could be. However, there might be a handful of people in our organizations who are actually very good, and we can go and talk and work with them and have them partner up with the rest of the parts of the team, and we raise our overall asset base. Yeah, and again, it's not about changing behavior, and I think that's the point I'm going to make in London in a few months' time. Is I'll be challenging our leaders to say, look, stop telling our teams to change. Stop trying to change behavior. The data suggests and experience suggests it's very difficult to enforce behavior change. But what we can do is what we've always known fundamentally is income follows on from assets. So if we address our asset deficiencies, not only do we sort of secure the short term, we also secure the long term as well for our finance professionals' careers, our team members' careers, and also give great potential back to the organization to drive even and unlock even more value for them. Look, I hope you all found this very useful. And again, if there's any other questions or any other follow-ups, please connect with me on LinkedIn or just send me an email to andrew@sitnshow.com. And again, really appreciate you investing your time with us today, and hope you have a great rest of the week. Take care.